I'm Tracy and I'm doing the videoing.
I'm Simi and I'm in charge of the visuals.
And I'm Cherry and I'm the one speaking.
To
Chocolate Truffles proudly presents to you the impact of a weakening US dollar on the Singapore economy.
So what is the impact on Singapore's currency?
As we all know, Singapore's exchange rate is linked to the US since US is one of Singapore's major trading partners. So why is the US dollar weakening?
Why?
Well, the US currency is in fact weakening due to the US national debt and a weakening economy.
So what is the impact on prices in Singapore?
From the diagram, we can see that the US is Singapore's main importer. A fall in the US dollar would lead to US imports being relatively cheaper and hence increasing the value of imports and decreasing the domestic consumption, as domestic goods will now be substituted by the US goods. The US is also one of Singapore's largest exporting partner. In 2009, US was ranked Singapore's third largest exporter. Exports will also see a decrease as exports would be relatively more expensive in the foreign market. Hence, ceteris paribus, a decrease in consumption, an increase in imports, and a decrease in exports would lead to aiding the country falling, causing a fall in prices as well. However, since Singapore exports value-added products with materials imported from overseas, cheaper exports would lead to a decrease in the cost of production, hence causing export to be relatively cheaper still. Hence, a weak US dollar would cause investors to pull out of the US as companies doing businesses there would have to pay more for the same products. These costs would be passed on to the consumer and would result in inflation. Investors in the US would hence shift their funds and investments to other stronger currency countries like Singapore. An increase in investments here would increase the country's aggregate demand in the short term, resulting in the increase in general price level and inflation rates. However, in the long term, inflation would ease down as an increase in investment would increase the country's productive capacity. The same, however, cannot be said about companies in Singapore who are doing businesses in the weaker US currency. Petroleum and oil-related industries, which also happen to be Singapore's main exporting industries, will experience rise in cost of production as a weak dollar tends to lift oil prices. This is because money shifts from the currency market to commodities in search of better returns. Higher prices of oil products will increase the cost of food and transport, which has one of the highest weightage in the country's CPI, hence rising other prices as well. As a result, inflation will occur. A weakening US dollar would also cause growing risks in capital inflows in Singapore due to the region's brighter economic outlook as compared to the rest of the world. A decline in the US dollar means that interest rates in the US are low and unstable as compared to Singapore's, which will bring high returns for investors. This would cause prices to rise in the asset market. Skyrocketing housing prices would cause a huge spike in the CPI, as housing is one of the biggest components in the CPI. This causes inflationary pressures and a growing estate bubble, which is detrimental to the Singapore economy. In the short term, inflation will cause our nominal interest rates to increase, resulting in a greater increase in short-term capital inflows, which will contribute further to higher inflation, as inflation rates. In the long term, a weak US dollar would result in appreciation of the Singapore dollar, hence making the Singapore dollar stronger. This will be helpful, in fact, in reducing inflation, as it will decrease consumption, increase imports and decrease exports as mentioned earlier. That is why the MAS has decided to implement gradual appreciation instead of zero appreciation policy to lower the prices in Singapore. As we know, labour is derived demand. Despite the weakening US dollar, the Singapore economy continued to create jobs in the third quarter of 2010, though the pace has eased from the robust gains earlier in the year. In the third quarter, for example, employment rose by 20,500. And in December 2010, unemployment rates fell by 2.1%. Aggregate demand, as we know, consists of the following components, which is consumption, investment, government expenditure, and net exports, which is the value of exports minus the value of imports. From 2007 to 2010, consumption expenditure for Singapore rose from about 64,000 million US dollars to 75,000 US million dollars. As the weakening of the US dollar also implies that the US economy is unstable, investors would flee the US and relocate in stronger Asian economies like Singapore. This scenario is evident as seen from the fact that the stock of direct foreign exchange at home increased to 200. Moving on, there is also an increase in another of the components of the AD, which is government expenditure. To sustain economic growth, the government has actually invested in the projects such as the Circle Line, Downtown Line, as well as the Jurong Island. Export demand will be relatively stable due to the strong Asian economies. While the value of imports is likely to increase due to the US goods being relatively cheaper than local and other countries' goods, overall, the value of exports would be more than the value of imports, hence increasing net exports. Hence, overall increase in the components consumption, investment, government expenditure, as well as net exports will lead to an increase in the AD, hence increasing employment as well. Balance of payments is an accounting record of all monetary transactions between a country and the rest of the world. These transactions include payments for the country's exports and imports of goods and services, as well as financial capital and financial transfers. So the impacts on Singapore's BOP can thus be categorized namely into the capital and the current account. For the capital account, the weakening US dollar would cause an influx of capital goods such as real estate investments. This would result in capital account surplus. However, inflationary pressures would result in the short term, resulting in unstable business environment and subsequent capital outflows, which would prove to be negative for Singapore in the long term. Singapore ranks top among Asian countries as the best real estate investment destination. As a result of the weakening US dollar, people and corporations are now purchasing more estate units, with the bulk purchase of units by companies increasing from 2 to 3% in the third quarter of 2010. Take the good class bungalow for instance. 54 out of the total good class bungalows have already been sold in the first half of the year at a high average price of $15 million apiece. With large amount of funds, foreign exchange entering Singapore must be converted into the local currency. The large flow of hot money will cause a sharp rise in Singapore's money supply, hence resulting in inflation. Hot money may also be creating bubbles in local stock and real estate markets. In the long term, with the accelerating inflation rate, Singapore would prove to be economically unstable, with investors pulling out of the country. For the current account, the sum of the balance of trade, net factor income and net transfer payments, Singapore's value of exports are predicted to decrease, while imports are likely to increase. A weak US dollar could hamper Singapore's exports, as major trading partners of Singapore have their currencies pegged to the US dollar. Combined with the US, they comprise a significant portion of Singapore's exports. Also, if the US declines, there may be some negative impact on investment decisions that US companies may make overseas, and these may include Singapore. The US leads in foreign investment, accounting for 11.2% of new actual investment in the manufacturing sector in 2008, and with $76.86 billion in total assets for stock of investment in the same industry as of 2009. This will impact us to a great extent since US ranks high in investments in Singapore. However, in the long term, owing to the fact that Asian economies are doing well, our exports will not be largely affected as our top two recipients of our exports are Hong Kong and Malaysia, both of which are Asian economies. On another note, the value of imports is likely to increase, as US goods are now cheaper in comparison to local and other countries' goods. Singapore's principal imports are crude oil, electronic components, industrial machinery, motor vehicles, food and beverages, and iron and steel. A weakening US dollar will also impact Singapore's economic growth. Economic growth is the increase in a country's productive capacity as measured by comparing real per capita income in a year with the previous years. This refers to the increase in capital stock, advances in technology, and improvement in the quality and level of literacy and labour. From 2008 to 2009, Singapore's exchange rate depreciated against the US dollar, at the same time recording negative growth of 1.3% in 2009. The Singapore dollar, however, appreciated in 2010. This time, Singapore's economic growth increased by an estimated 14.7%. Although overall, Singapore registered positive growth with the US dollar, the same cannot be said with companies in Singapore who are doing businesses with the weaker US currency. Take the High Flux Group, for example, which sells water treatment systems. The weakening US dollar against the Singapore dollar led to a foreign exchange loss for the group, which amounted to 7.9 million Singapore dollars. This is because cost of production went up by 10% to 121 million Singapore dollars. Hence, the weakening of the US dollars has caused some companies to not be able to sustain their businesses in the long run. The weakening of the US dollar has also had implications on the employment level of Singapore. The weakening US dollar has caused the retrenchment of many people due to the closing down of companies owned by the US. But construction of the IRs in Singapore to boost tourism and exports and increase in government spending on projects such as Circle Line has increased employment and helped employment despite retrenchment by US companies. This will help to boost economic growth both in the short term and the long term, as more employment would mean more income would be spent for consumption. There will also continue to be strong economic growth in the Asian region due to high intra-Asian trade. These trades have also become more important to Singapore than trades with the US. In September 2010, for example, Singapore's non-oil domestic exports to countries in Asia increased as compared to the same period in the previous year. Comparative strengthening of the Singapore dollar to the US is related to foreign inflow of funds that increased due to the growing relative attractiveness of Singapore. Inflow of funds should supposedly be competent in improving the economic growth of Singapore in the long term. However, a weakening US dollar will also cause growing risks in capital inflows in Singapore due to the region's brighter economic outlook as compared to the rest of the world. Therefore, high prices causes inflation rate, which may prove to be detrimental to long-term economic growth. In Singapore's case, however, the improvement of relative attractiveness will likely lead to more inflows of foreign funds. This can be done through product differentiation and repackaging. This often leads to increases in equity prices that will eventually create growth. Foreign direct investments made by companies who wish to tap into the Singapore's market due to favourable investment conditions put in place by the government will increase the potential growth of the economy as well. Well, that's all for today. Thank you for your kind attention. Bye!